So if you've been watching the markets, especially the tech indices, you'll know they've been on a roller coaster through the end of 2025.
A real ride.
Exactly. And what's so unusual about all this volatility isn't really the dip itself, but that there's no clear trigger.
Right. No obvious external shock.
Yeah, there's no big geopolitical crisis, no clear reason for the turbulence. It's all happening against a backdrop of this um, truly unprecedented and very, very concentrated equity appreciation. Okay, let's unpack this.
And that concentration, that's exactly the paradox we're digging into today.
Hmm.
It all really stems from that foundational shift that started back in late 2022.
With the release of the big generative AI models.
Exactly. The market just decided almost overnight that this technology was worth astronomical sums of money.
And when we say concentration, the numbers they're genuinely jaw-dropping. We're focusing on this small cohort, the so-called Magnificent Seven.
A handful of hyperscale tech firms, all structurally committed to winning the AI infrastructure race.
And our source material for this deep dive points out a stunning fact. Roughly 1/3 of the entire S&P 500's market cap is rolled up in just this tiny group of companies.
Which creates a huge dilemma for investors, and that's really our mission for you today. Are these extreme valuations, I mean, they're predicting a future of almost unimaginable super profits. Are they a genuine economic revaluation?
Or is it something else?
Or, as the analysis we're looking at today suggests, are they mostly an artifact of what's being called circular capital flows? The core thesis here is that this exponential AI valuation isn't being fueled by real external economic output,
But by internal spending.
by the internal spending of a few giant buyers. They argue it creates this illusion of broad market vitality.
So our goal here is to peel back the layers on that illusion. We're going to dissect the tech that enabled this concentration. We'll try to quantify how much this is just self-referential capital, and then, assess the huge systemic risk that's baked into this whole setup.
We want to give you a shortcut to understanding these incredibly complex financial dynamics and the structural risks that are hiding in plain sight in this very highly valued AI industry cluster.
To really get the foundation of this paradox,
Mhm.
we have to start with the company that's benefited the most. We have to talk about NVIDIA.
Absolutely.
Their transformation from, a specialized graphics card maker for video games
Yeah.
into one of the world's most valuable corporations.
Wow.
It's the pivotal case study. It was all because of this brilliant, really prescient pivot to general-purpose computing, GPGPU.
That pivot wasn't just brilliant, it was economically locking. The source material notes that by late 2025, NVIDIA commanded, an estimated 90% market share in the AI accelerator space.
90%. But hold on. Haven't we seen this before? I mean, Intel dominated chips for decades. Oracle had databases locked down. Why is NVIDIA's dominance different? Why is it so central to this circular capital idea?
That's a great question, and the distinction is critical. NVIDIA's economic moat isn't just that they have the fastest silicon, it's the software. The key is CUA, their Compute Unified Device Architecture. The easiest way to think about it is as the proprietary operating system for all of AI.
So the chip is the hardware, but CUA is the language that everyone is forced to speak.
Precisely. CUDA is the industry-standard programming interface you need for the parallel processing that makes large-scale AI training possible. Our source calls it a non-price mechanism of lock-in.
Meaning what, exactly?
It means you have decades of developer experience, all the optimized code, all the academic research. It's all built on NVIDIA's platform.
Right.
To migrate to a rival's chip would be almost impossible. It would cost billions and take years.
So if you're one of those big buyers, the AI oligopsonies, the paper calls them, Meta, Microsoft, Google, Amazon, you are functionally forced to buy NVIDIA's hardware
You have to.
because you need access to that software moat to stay efficient. There's just no other viable option.
Correct. And that gives NVIDIA immense leverage. It lets them extract massive economic rent from the very few companies trying to build their own AI dominance. This technological lock-in is the absolute precondition for the financial lock-in that we're about to get into.
Okay, and here's where it gets really interesting. This is where we move from a tech necessity to what feels like financial reflexivity. If these valuations were totally real, you'd expect to see demand coming from a wide range of external, profitable customers.
But the source material asks us to be pretty skeptical about the authenticity of that market demand.
And this is where the money starts eating its own tail.
It is. The sources point to these huge transactions that are structured a lot like vendor financing. A key example is that reported $100 billion commitment to OpenAI back in September 2024.
Right, I remember that. It was framed as this massive investment that validated OpenAI's huge valuation.
It was. But when you look at the practical reality, it often works like this. The capital that's provided by the technology supplier or one of its big partners is essentially funding the client to then turn around and buy or lease that same supplier's infrastructure.
Okay, let me make sure I'm getting this straight for everyone listening. NVIDIA makes the shovels, the most essential tool in this gold rush.
The only real shovels, yeah.
Then they effectively lend money to the prospectors, the AI developers, so that the prospectors can afford to buy the shovels.
From NVIDIA.
From NVIDIA. And then NVIDIA gets to turn to the market and say, look at our incredible sales figures. Our stock must be worth triple.
That analogy absolutely nails it. That recycling of capital is what the sources call synthetic demand. The sales figures start to reflect the velocity of capital, how fast money is moving around inside this small circle, not real market validation from outside customers paying with their own unrelated profits.
It just blurs the line between actual market growth and, I guess, manufactured momentum. Is there any way to, put a number on this? How much of their sales could be from these kinds of circular deals?
We can put a number on the opacity at least. Analysis from firms like Goldman Sachs suggests these arrangements could account for up to 15% of NVIDIA's projected near-term sales. But it goes so much deeper than just one company.
I can imagine this isn't an isolated thing.
It's not. The entire market is this dense, tangled web. You've got Meta, Google, and Amazon as the main buyers, but they're all heavily cross-invested in the smaller AI startups. Those startups are customers of NVIDIA, who is a key partner to TSMC, who makes the chips for literally everyone. It is a fundamentally self-referential network.
That sounds less like a competitive market and more like one single, highly correlated financial organism. What's the implication for global risk?
Systemic correlation risk. That's the implication. The stock prices of the big buyers and the main supplier aren't independent anymore. They are fundamentally tied together. If the AI services don't make the profits everyone expects, that devaluation just cascades backward, hitting the supplier's revenue, and vice versa. It creates this structural opacity where a failure on one side can just rip through the entire cohort.
Which leads us right to the big unsolved problem here. The actual unit economics of the services these trillion-dollar valuations are supposedly built on. Let's use OpenAI as the prime example. It's such a perfect illustration of the gap between tech capability and economic viability.
It is a mind-boggling disconnect. The company, as you know, approached a valuation of $500 billion, one of the most valuable private companies in the world, and yet projections reviewed in our source material suggest potential cumulative operational losses of over $70 billion in its first 3 years.
Hold on. $70 billion in losses, while the market says they're worth $500 billion. That isn't just, running in the red. That's a structural cash burn. How can a service that everyone is using be so profoundly unprofitable?
It's what the source calls the cost disease. And here's the core paradox. Normally, more customers is a good thing.
Right. That's business 101.
But here, more adoption actually accelerates the financial losses. And the reason is the marginal cost of inference. Every single query you put into a large language model costs real money in computation.
So every time a new user asks a question, the company loses a few cents. Or maybe even a few dollars if it's a complex request.
Exactly that. The cost per query is not trivial. It could be cents for a simple text response or multiple dollars for something complex, like generating video. And because those costs scale linearly with usage, success itself becomes a massive financial drain.
So if they succeed in getting market share, they also succeed in burning through cash faster than they can possibly replace it with subscription revenue. What's driving those costs? I mean, we know the chips are expensive, but how expensive are we talking?
Well, there are three main cost drivers. First is just the extreme CapEx, the capital intensity. And let's just pause on this number. A single high-performance GPU, the workhorse of this infrastructure, costs around $40,000.
$40,000 per chip.
Per chip. And a major installation needs tens of thousands of them. That is an astonishing amount of initial capital.
And a huge barrier to entry for anyone who isn't one of the Magnificent Seven.
Absolutely. Second factor is the high OpEx, the operational overhead. This is the ongoing expense. You've got massive electricity bills, complex cooling systems to stop the whole thing from melting, and constant maintenance. And crucially, these costs scale linearly with use.
And if you're in an arms race for tech leadership, you can't just pause the spending. You have to keep building.
Which brings us to the third factor, infrastructural overcommitment. To stay ahead, you have to preemptively build out these massive data centers. So you're committing billions in capex long before you've proven that profitable revenue streams even exist to pay for it.
When we talk about massive capex, my mind always goes to historical parallels, like the railway boom or the electrical grid or even the fiber optic cables. Those are also huge investments.
And that comparison brings us to a really fundamental risk distinction. Traditional infrastructure, like railways and grids, they're characterized by incredible asset longevity, low technological volatility.
Right, a railway line built 150 years ago still works. It holds its value over, what, 50 years or more?
You cannot do that with a microchip. AI infrastructure faces two intense pressures at the same time, which our source calls hyperdepreciation. First, there's physical degradation from running them at max power 24/7. But second, and way more critical, is the Moore's Law effect, rapid technological obsolescence.
So the hardware might still physically work, but becomes economically useless because the next chip, 6 months later, is twice as fast and way more energy efficient.
You've got it. The economic utility of older hardware just falls off a cliff, often within a super short window of 18 to 24 months. Running the old stuff becomes cost prohibitive, and this creates a concept the paper calls compressed time to value, or CTV.
That's the financial deadline. It sounds like they have to make all their money back on this massive investment in under 2 years.
That's precisely the urgency. Unlike a railroad that can wait decades for the market to mature, these AI data centers have to generate enough economic output to cover their huge capex and opex within that narrow 18 to 24-month window, before obsolescence just erodes their value completely. It's a fundamentally different risk profile.
And that urgency makes the sheer scale of the investment so concerning. As of late 2025, tech stocks are almost half of the total U.S. equity market value. And since the U.S. market is over half the global market, well, risks inside the Magnificent Seven effectively become systemic global risks.
You really have to do a global scale check. The combined value of just those 7 companies is around the GDP of several major nations combined. NVIDIA alone often has a market cap bigger than the entire stock market of some industrialized countries.
So if that technological clock runs out and the profitable applications haven't materialized, or if a competitor somehow breaks NVIDIA's software moat, that structural entanglement means you'd see a highly correlated crash across the entire global financial system.
That is the risk. The enormous spending and unprofitability we're seeing, it's not defended by current cash flow. It's defended by what's called the extrapolative investment hypothesis. The bet is that some eventual transformative application, AGI, superintelligence, call it what you will retroactively justify all this spending.
And the people who believe in this always say, oh, it's just like the railroads or the internet build-out. But this analysis argues that the AI situation is fundamentally different. What are the key distinctions?
It identifies 4 critical distinctions. First, asset longevity. AI hardware has a lifespan of 18-24 months versus 50-plus years for historical infrastructure. Second is demonstrated demand. Railroads solved a clear, pre-existing need for transport. Many core AI applications are still speculative.
And the last 2 points tie directly back to the self-referential money loop we talked about earlier.
Exactly. The third is circular financing. Historical capital came from external bond markets or proven utility revenue. A significant chunk of AI demand is supported by internal, vendor-financed capital, synthetic demand. And finally, the scale of the speculative premium. The sheer proportion of global capital being bet on unproven unit economics in AI is, right now, historically anomalous. The bets are just so much bigger on assets that are so much less durable.
So what does this all mean? When you put it all together, it looks like a market structure built on an immense leap of faith, one that has pushed a huge structural risk right into the core of global finance.
I think we can draw 4 provisional conclusions from the analysis. First, current valuations include a massive speculative premium that's betting on a transformative future. Second, there's immense structural opacity because of these circular capital flows, which makes it incredibly hard to assess the real risk.
Third, there's that urgent deadline, the temporal constraint of compressed time to value.
And fourth, this unprecedented concentration creates a significant systemic correlation risk that stretches across global markets. This AI market isn't a simple bubble, and it's not a guaranteed success story. It's a period of truly elevated structural uncertainty.
The risks here are foundational, not just your typical market ups and downs.
They are. The outcome hinges entirely on one call. Can the transformative potential of AI translate into economically sustainable business models within the compressed timeframes imposed by its own rapid evolution? If the AI revolution delivers brand new, massive revenue streams before that 18 to 24-month clock runs out on today's hardware, the bets will pay off. But that fundamental translation from a cool technology to a scalable, profitable business, that remains the great unknown facing every investor in the world right now.